Now we're going to go into the OPEC side and what are some of the things that are happening in general. So here you can see just the IEA is seeing a deeper supply deficit, something that we've talked about. The question is going to be what happens at the OPEC meeting, because when you look at the OPEC meeting, one of the things that we're starting to see, obviously we had the fun comments from Saudi Arabia reiterating that they're going to make the shorts hurt. They're going to make the shorts ouch, as they've said. But the question is going to be, do they have the political capacity to get another cut? And the short answer is, I don't think they want to. I think the biggest focus right now at this on June 4th is going to be talking about how effective they've been at getting the cuts done, how they've been able to achieve it, how they've achieved it in unity. Because the UAE has made mention that they don't expect additional cuts until at least sometime in the end of Q3, beginning of Q4. So I don't think there's a huge willpower, if you will, to make a cut. So I think there's a non-event. I don't think there's anything additional. The surprise could be the Saudi doing what they did. I think it was either in 2020 or 2021, where they did that voluntary cut. So they themselves were the only ones that cut. I don't think there's any reason to do it now. I think the goal for OPEC is $75. They've achieved that. I don't see any reason to get in the way of it. The U.S. activity, as we've talked about in the frac spread count, has slowed. That's going to put some hair on where our exit rate is. We were estimating an exit rate of about 12.7 million barrels a day. There's now downside risk to that. Is it 12.5, 12.6? I think the summer is going to kind of tell, just because we want to see how quickly we get a bounce post Memorial Day weekend, because Memorial Day weekend is that key, like that low point, and then you start to get those increases. So here you can see that, on a 2023 average, OPEC has us in a deficit of 700,000. IEA has us in a deficit of 1 million. EIA has us in a surplus of 300,000. So we're right in kind of on this cusp. And the question is going to be, does supply dip or does demand dip? And again, demand doesn't dip as much as anyone ever thinks. And we're not foolish to that. The question is going to be the industrial slowdown mixed with the consumer slowdown. So you can get periods of some extra stress, especially if you get the consumer slowing to a degree. But because of price, that's going to be more of along the lines of the 70 side, where you're going to have that 70 pressure because you're going to have supply, not rising. You're not going to, and you're, guys are willing to cut and protect a certain line in the sand, and demand is, can only come down so far. So again, there's going to be that balancing act, which is why we don't see, let's call it Brent at 77, 78 going to 38 like we did in 08. It's more along the lines of, do we come into the mid 60s? Do we come, is that the low point? And that's going to be that back and forth in terms of where things are. And that's why we see, and we've talked about on the Econ show, the pressure on the economy. It's not going to be this huge drop of, the economy went down 10, 15%, this quarter, this year. It's going to be down 0.5%, 1%, going to have that kind of that slow bleed that's just going to permeate through the system. Then when we look at OPEC plus supply, so here you can see that monthly oil supply fell 251,000 barrels. Most of that was driven by Iraq and by Nigeria. And again, that was a mixture of the loss of not going through the CN pipeline for Iraq. You had some force majeures in Nigeria, some reductions because of maintenance. Excuse me. So you're not seeing a huge adjustment, but then you look at Saudi had a small increase, UAE kind of right in line. And the difference that we always like to call into to attention is production versus exports, because they want to show you the right hand and say, oh, well, we're cutting production. Look at the production we cut, while their exports are the same. And so again, you want to see how do the production cuts adjust exports. If it doesn't adjust exports, nothing really changed. When you look at Russia putting so much crude on the water, you're going to have to see some adjustments. And are those in a good or bad way? And that's when you look at some of the pricing with kind of West Africa stuck in the middle. They even at a very reduced number, well below, like when you look at, actual levels versus quota, you're still well below quota. And it's all driven by West Africa because there's no real impetus and demand for it. And that's because Asia is buying a lot of Russian product, a lot of Russian crude. There's no need to continue to buy to these levels, which again is putting some of those headwinds in. Middle East crude oil floating storage, as we've been saying, trending a bit higher, still fairly stable. The question is going to be what happens going to the next level, because you're seeing it, Middle East crude getting expensive against Brent. It's still very expensive against the U.S. crude. It's expensive against West Africa. So there's really no impetus for any swing buyer to come in and pick up extra cargoes. If anything, they're going to stay a bit depressed. And again, that's something that we think is going to continue to play out. When you look at the U.S. exports, 4.1 million barrels, again, just staying at that infrastructurally, cap at this point. But based on everything that's happening by Saudi, by OPEC, our crude is going to continue to be in demand. Now, when we look at gas oil, one of the things on the crack spread side, which we've been talking about, is we were going to get a bounce, but then the bounce was going to fade. And we see that fade in Asia, particularly actually accelerating to the downside. The U.S. is going to have a little bit more staying power on the crack spread front, just because of where storage is, because of the low, our refiners operating on the lower end. It's the Asian one that we think is going to have a bigger crack. And that's the difference that, as we talked about in segment 1, between that East and West. East Suez is in trouble because China is going to export to such a degree. And we have that contraction on the manufacturing front and the industrial front because things still continue to be in contraction. And that's something that we've talked about extensively on our econ shows, which is going to pull this down. And as this approaches $10, we do expect to see some of these issues in terms of run cuts. And again, it's not going to be China. China's buying cheap Russian crude, cheap Iranian crude, cheap VGO or vacuum gas oil, and they're going to be able to sell product at a discount, which is still going to be profitable to them, but a discount to the market, and the Asian refiners just can't compete, and that's going to create some additional stress. Here you can see Dubai versus Brent. There's these pressure points, and these pressure points remain. And based on shipping, based on rates, it's getting harder and harder to say, well, I should be buying Dubai instead of Brent. So again, that's going to create some of that pressure point. Crude oil in the water, going to stay elevated. There's a lot of it out there. Obviously, Iran's putting a bit more on the water. Russia's putting a lot out there. But even as Russian product goes into some storage or gets bought up by some other countries, they're just taking that Russian crude, playing the arb, and just exporting more of their own crude. So again, you're still, no matter who is absorbing it, you still have an extensive amount of crude on the water, which is why crude oil in transit is going to remain at seasonally adjusted all-time highs. Now, crude oil and floating storage, you're starting to see that trend up. But as we've been saying, it's going to be at 2022 levels. We're not saying the trend is going to be, back to 2020. You have a lot of product in the water. You're going to have a lot of delays in getting that product off the water, and that's going to keep us at a very elevated point around the world, especially as some of this shows up in Asia. And as we've been saying, we expect Asian product, depending on when it shows up on the coast, to have a sizable increase. Now, you might have seen some of the talk about, Chinese, a new strain of COVID. There's no lockdowns. There's likely to be minimal impact, if any. So again, it's not going to put a surge of product on the water. It's just they continue to be very active buyers in the market, well above seasonal norms, still on a descending level, but active. And that's going to put more product in floating storage, which is, again, going to put pressure on West African flows, Middle Eastern flows, as they continue to work through what they purchase from Russia, as well as what comes off the water. Here's the crude supertanker crude imports. Again, the trend is down, as it always is. I mean, seasonally speaking, we're coming into the low point, which is that, really the end of June, beginning of July is kind of like the floor for some of the buying from China. But this is going to be an important one to watch as we go forward, because when do they kind of max out the storage they're willing to, because they're taking advantage of such discounted product. When we look at activity in China congestion, as we were saying, it's going to be above 22, but it's not going to go back to the surge that we had from the reopening. It's going to be a bit muted. And I think realistically, and if you look at what happened prior to Labor Day week and now post Labor Day week, you're not getting back to the high. And I think that's the thing that people are going to struggle with, because you just don't have the same level of activity, because people are getting back to normal and back to kind of basics and just falling back within their routine now that they've made up for what they didn't do during that lockdown period. And this is some of that disappointment. And again, let me be clear. It's not disappointment where it's like, oh, China's congestion is negative again. No, it's the level against where the market is anticipating. And as we've seen with the IEA, as we've seen with OPEC, there's this huge anticipation of China coming back and just spending and buying and driving. And it's just, we're sitting there saying it's going to be better than last year, but not a huge surge. And that's going to be some of that rewriting in terms of demand, which is why we do see the deficit that IEA and OPEC are expecting to close a little bit. Not to say that they're going to come in and say, oh, we're back to a surplus. No, it's just there's such a fine margin of error of in a 100 million barrel a day market. If you're saying that we're going to be in deficit of 700,000 barrels a day, well, that could be a little bit of China, that could be a little bit of the US, and all of a sudden you're flat. So again, this is why we talk so much about expectations and where the market actually is based on the data. You have Chinese refiners coming out of refinery maintenance. That's going to continue. We don't see that changing. It's going to just trend back to normal. Right now we're at 62.8% utilization rate. We expect to be at about 64 to 65%, so very normal in general. And they're going to try to take advantage of the fact that they have pretty wide open export quotas right now. And based on that arbitrage, you're going to make some decent pull. West Africa had some decent discounts roll through, which sold some additional cargoes. Nigeria is still sitting on a ton of June. That is a problem. Angola has cleared for the most part with their price reductions. You do have some resales, but again, nothing major in terms of the Angolan side. But that's where now, as Nigeria struggles, and you have actually had Angola increasing their commentary or increasing their production numbers, we expect this to stay at a very high level when we look at floating storage. Crude exports, product exports from the U.S., gasoline dropped 219,000 barrels a day. Distillate dropped 322,000 barrels a day. That's where it's coming closer to kind of what we've talked about. Propylene had a drop of 314,000 barrels a day. But again, even with that drop, you're still above the 5-year average. It's going to ebb and flow. You had a nice increase in crude oil exports, but again, it's all that timing area. So that's going to be an important piece to watch as well. Now, when we look at gasoline, as we were saying, and seasonally speaking, there's normally a drop this time because you're coming into Memorial Day, you're coming into the big surge of the beginning of summer as people prepare. The question is going to be going forward. So I think we have a drop towards the 5-year average, and then we just kind of suck around that 5-year as we go through the next few weeks. Distillate, on the other hand, you had that drop. We think that obviously you get a bounce, but it's going to bounce and be below the 5-year average. And this is going to be the start of that pressure point where we're just going to trend well below, within the bottom of the cloud and below that 5-year average. Crude oil exports, again, because of the margin, because of the ARB, it's wide open. We're going to continue to see that moving through. Propylene, as we talked about in our insights and as we've talked about in just the general chem side, you're still very strong. We're still seeing a lot of that flow. So again, you're seeing a lot of those benefits in general. Ethane exports staying strong. We're going to stay at the top end of the range. Ethane and propane are two of the only places right now that we can really, make a margin on cracking. So that's going to continue. Now, when we look at Fujairah, you reported you had a drop of about just over 2 million barrels, 2.049. So it came in at 22.851 million barrels a day. And the drop was really driven by heavy because light and middle distillate actually increased. Light distillate rose 83,000 barrels. The east of Suez gasoline complex got a little bit better just because of some of the crack differentials with Memorial Day. But looking ahead, Singapore reforming spread is expected to widen in June as gasoline prices rise during the driving season, while the Asian naphtha complex softens amid that poor downstream demand, again, coming back to the chem side, which is why naphtha is coming down a bit. A lot of propane demand. And that's where, again, we kind of are in this middle point where we expect to see some grinding builds in light distillate, especially as some of the demand remains a bit slow and we don't have a huge amount of activity. Middle distillate rose 170,000 barrels to about 4.729. Backwardation, the east of Suez gas oil market eased a bit, but market participants saw some support that remained in the near term. But again, some of the strength was attributed to some of the slowdown in supply for June loading cargoes because you had some turnarounds in Asia, as we've talked about. You had some disruptions because of weather in the Middle East. As that clears, we do expect to see that steady grind of storage increasing from middle distillate, which again is going to be put a little bit of pressure on that market because of those ARB shifts. Heavy resid was the main reason for the drop. It had a decline of 2.3 million barrels. Spot trading was seen kind of range bound, below average, moderate at best, amid high winds and rough seas conditions. You had some of the refueling operations facing some challenges and some delays, which also delayed some of the offloading. So again, we do expect to see a bit of an increase on that front as well. Brent time spreads, again, remaining under pressure. To the point where we've been talking about, there's not a lot of strength in the market in the near term, fairly balanced at this point with some downside that we expect in as we go through June and into July. When we look at expectations, you can see Nigeria trending up a bit. You can see Angola is the one with the big pop of about 200,000 barrels a day. So remember, you had some reductions from the Middle East, but now you're getting a little bit of an increase from Angola. This is why we've talked about some of those pressure points coming into West Africa. In Nigeria, QEBO, OSP lowered to dated Brent to negative 39 cents, weakest since October of 2021, decreased from a positive 2 cents. Forcados cut to dated plus 21 cents, lowest since November 2021, dipped from the low of 31 cents in May. And then there's a Senegal spot offer that saw price declines of 10 cents. So again, you're just seeing some of these cuts in general because, the one thing is, like we talked about, the physical market is still soft, but it's finding a bit of a floor. So the question is going to be, is there going to be enough of a floor to see some increases, or are we going to see some continued declines? Realistically, I think you're going to have a bit of a stalemate, and you'll likely see prices hold here. We're at the end of the month. Beginning of the month is you have some support and some guys trying to get some deals, some early buying in June, which should put a little bit of a floor in pricing, but we do see declines continuing in June. ARA, as we were saying, we were going to get some of those, some stabilization in storage. Not surprising, just given that the pull down of storage, floating storage moving onshore. Now, when we look at products, gasoline had a small drop of 47,000 tons. Or it's just 47 to 1.38. Again, still very elevated in general. Gas oil had a build of 15. We're now over 2.5. Again, you're seeing the trend. It's like there's the economic slowdown in Europe. That's continuing, and you have that arb between west and east closed. So that's going to put some fuel oil back here. And again, this is why when you look at gas oil, we see some of those slowdowns in terms of exports from the U.S. Gasoline still seasonally adjusted record high. We're above 2020. We're above 2022, and this is going to put pressure on buying. This is going to put pressure on the ARB, which is why the ARB, or I should say, it's going to put pressure on European prices as U.S. prices remain elevated, keeping the ARB open, which is why we see imports remaining strong from Europe into the U.S. Fuel oil coming down a bit, but this is the second highest ever, which is why, again, you're seeing these pressure points, and Europe is going to have to figure out what to do with it. Is it going to recrack it? Is it going to just dump it into the market? Likely a mixture of both, as we see some of that softness. And then when we look at Asia, it's remaining fairly flat when you look at it against the average, because there's a tale of two cities. Light distillate, seasonally adjusted, all-time highs. We don't see that changing on the light distillate gasoline side. Middle distillate, it's flatlining here, but it seasonally usually flatlines here. What we see when we look at the middle distillate over the next 4 to 6 weeks is some upward pressure as we have industrial production, industrial activity slowing, and some of those additional exports from China starting to hit the market. And this is going to drive us up, but still be below the average. We're not saying that we're going to get this massive surge, but as we start to grind this up, because we're getting softness in the crack spread at this level of storage, to give you an idea of some of the pressures in the market on the demand front. When we look at resid, you had a nice kind of drop. Again, they're just going to try to manage this, but because the ARB is closed west to east, and China picking up a significant amount of VGO, heavy resid, heavy disty in the near term, that helped pull this down. We do see this just trending back towards the average. North Sea flows, again, because of pricing, these are going to stay low. There's a lot of reasons to buy this crude versus Saudi and Middle East. And the same can be said for Europe when you have those floating storage falling down. So again, that's what we have for you on the holistic side. If you have any questions, please feel free to reach out. Otherwise, we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.